Is there any theory behind real estate agents calculating the price of a property for advertisement purposes? I'm observing that if the property valuation is coming in at 510, then the real estate agent is generally expecting 520 during the conversation. And even according to them, 520 to 530 is the right value. How are they getting these valuations when our comparative market analysis is, say, 510, and that's where we're seeing the right amount of value? So there's a number, I might just probably answer this question in a number of ways, if that's all right, because there's a couple of concepts that we want to apply here. The first one is the pricing strategy used by the sales agent and vendor. The next one is the target or estimated purchase price. What do we think, based on the sales campaign and talking to the agent and doing our due diligence, can we buy that property for? And then the third thing that we look at is the appraised value. Where are we seeing value of that property? And we need to really understand that these things in isolation, but then bring them together to really work out what we're going to be paying for this property. So different real estate agents work in different ways. They have preferred, I guess, methodologies when listing a property. Sometimes they change those strategies based on the property, based on the vendor, and then sometimes they change those strategies based on the market conditions. You know, is it a buyer's market? Is it a seller's market? At a really high level, you might have a real estate agent who's buying a listing. Okay, they might be over-promising the vendor in terms of, I think we can get $600,000 for your house, and being all slick and smoozy, and the vendor's like, really? Oh, wow, that'd be amazing if you get 600. I'm going to sign you up, go for your life. Generally, when that occurs, you see a listing like the one we saw before in our property search engine, okay, that might be on the market for 800. Where was that one? I'll bring it up and see if I can find it again. It might take a few seconds to load. It was on the market for $890,000, and then 3 days later, it was discounted down to $850,000. Now, for that to occur, something is going on there around the expectations set by the vendor and the sales agent, and they're already starting to have some conflict there. So that might be an example where the agent has bought the listing by over-promising. The vendors love what they hear, and then very quickly the agent starts conditioning the vendor and their expectations to reduce the asking price to create some demand. Okay, they might use a couple of early indications of what people are willing to pay to justify and convince the vendor to start decreasing the asking price. Now, typically this is a strategy used in markets that are sellers, that have, I guess, less demand, higher days on market, less turnover. Not a huge amount of heat in the market, and the sales agents are really scrambling to get listings. Now, on the other side of the equation, you have sales agents that call, I guess I call this a pyramid strategy. They might be, convincing the vendor to start off low, start off with a lower asking price, attract a huge amount of interest in the property, and then start stacking offers based on who is making them. So hopefully they're getting a few investors on the table earlier on in the listing campaign. People are going through the open home, and there's dozens and dozens of people there, and they know that there's a lot of interest in this property. They have to be very commercial in their offers. Okay, they were trying to form a base of a pyramid with lots of interest at a lower price point. They then use that interest. There might even be 3 or 4 offers from investors on the table who have, far higher price sensitivity, lower emotional input, to then form a base of the pyramid where they are trying to attract a couple, 2 or 3 is optimum, owner-occupier offers that have a little bit more emotion, and they use those investor offers to really prime the owner-occupier offers at a higher price point. And then they hopefully get a couple of really good competitive owner-occupier offers, and then they really go in for the kill and try and snag that one top of the pyramid offer which blows the other ones out of the water. That is an optimum pyramid type sales campaign. You use this when you have a really good agent who has a great database, a great ability to market a property. I've sold a property that I've had that got a market record price using this strategy in the past. When I knew the agent was able to do this, they had 2 agents that are actually on the case for me. They had an assistant. We had 70-something offers, people through the open home. I think we had 12 or 14 offers really quickly on the property, and it was that emotional one buyer that came in and blew the others out of the water because you had that pyramid built up. You could only get away with this in really heated markets when you have really strong operators sales agents with really good track records that can put their reputation on the line and come into the vendor and say, I would suggest you start low and we end up far higher, and my reputation backs this up. And that's sometimes not what a vendor wants to take the risk on, but when the agent does have that reputation, they can secure the listing by using that strategy. Now we have all other strategies in between. Generally at the moment, agents are, in parts of very sort of WA and South Australia that are really booming. They're really going ahead. You've got a lot of agents in the market that just don't have a clue what they're doing. And when the market starts slowing down, they'll all go back to selling gym memberships. Okay, it's probably a little bit of a rude call there. But in this type of heated market, sales agents are not really thinking too much about this. They are appraising a property. They're putting it on the market. They might be using their network or some kickbacks, etc., to get the vendor to sign up with them in the first place. Then they are putting the property on the market based on their fair market valuation, and generally in a rising market, that it's going to sell for more than that fair market valuation. And that might just be the 2 or 3% increase over that 2-month period of the sales listing that really generates the type of growth that we have in the market. The sales agent is not really contributing much value to this equation at all. All right, so for me, most of the time at the moment, we are not seeing the buying of a listing, and we're not seeing the pyramid type strategies or campaigns. In the investment grade markets with extremely low vacancy rates across the country, we are just seeing very generic real estate listing campaigns. Them doing, conservative, comparative market analysis, pricing the property there, and then generally the competition is occurring above the asking prices. It might be 2 or 3% above. That's what we're seeing as a standard. You always see a inferior tier of sales agents, right? I noticed a property that, just around the corner from where I live. It was a $2.4 million property every single day of the week. Okay, I know the market. It's very intimately. I know every street very intimately. I live there. I have lived there for many years down here in Hobart. It was an over $2 million plus property every day of the week. It was a little bit tired. It was listed with an old school real estate agent. The type of agent that has their name is the name of the business, and they're really the only sales agent in that business. And they might have known the person who's owned that or the family for the last 30 or 40 years, and that's how they get the listing. That property sold for just over $1.5 million, potentially 50% under fair market value, right? For me, I wasn't actively looking there. For me, that's it's difficult to value that type of property because it is in that particular suburb a lot of variance. It only has 10 sales a year. There's a lot of variance in properties. You have a vendor that doesn't know what they're doing, listing with this agent that doesn't know what they're doing, and then you have a buyer that's very opportunistic, coming in and securing that property for an extremely strong result. You always have those really low standard of agents, but they have less opportunity to stuff it up in a heated market. Okay, so that's probably the other point here. You're always going to have those bad agents. Knowing how to identify them and how to use them to your advantage is sometimes how we get the best deals. But that's a really interesting case study here around how sometimes you can find these opportunities in the market when the property isn't listed and marketed correctly. In a heated market, there are far fewer of them. But I'm trying to probably give a lot of that clarity around how properties are priced. Generally, 90% of listings at the moment are priced at CMAs, comparative market analysis, knowing that they will, generally be somewhat above that, 2 or 3% in these heated markets. The next number that we look at is our estimated purchase price, right? So we look at the for sale listing, we look at how long it's been on the market, we look at how that compares to the overall suburb. We look at, has the agent discounted the property at all? Have they gone from an auction, realising they don't have enough interest and moving it to a fixed price? We're gauging the overall distress of that property, and then we're looking at the general discounting or lack of discounting in that market. So the property might be on the market for 500, and we do that analysis and we might determine that it's likely to sell for 480, 450, 520. So the asking price is irrelevant for us. It is one factor that we go into in determining the target or estimated sale price. The next major element there is talking to the sales agent. I've just been very upfront with them. A technique that I use quite successfully is asking them, after you have, talked to them a little bit, gathered the information that you need to know about the property, asking them point blank, I can move on this property very quickly. What would get this sold today? And then being silent, not talking. Okay, let them fill the silence. Just letting them fumble around. Some agents will say, asking price, thanks, mate. Most of the time they'll say, whatever's on the asking price there, mate, don't be silly. But sometimes you get some crazy numbers and you'll be surprised. 1 in every 5 times when you do this right, you'll get an agent coming back, 3-4% less than the asking price, okay? You never know what they will say. Typically it's less likely in this type of environment, but that's also a strategy. Whatever the agent says there, generally that is a large factor that determines our estimated purchase price, target purchase price. Then we go on to our comparative market analysis. That is when we're looking at what we feel the appraised value of the property is, and then that has to stack up and be equal to or above our estimated or target purchase price. You can see here the asking price is almost irrelevant. So for me here, just to summarize, our CMA, our appraised value, is the number one truth. We then look at the asking price, we talk to the agent, we look at the distress of the market, how long it's been on the market, has it been discounted, and we get a feel for where we see this eventual sales price resulting in. If we feel that it's most likely that's going to be above the appraised value, then it's not really much point observing that one or really spending any more time on it. If we feel like we've got some skin on the game, then now we start potentially framing up our negotiations and doing that final due diligence. Hopefully that answers your question there. It's a really good one.